I'm Larry Walther. This is principlesofaccounting.com, Chapter 15. And in this module, we will consider the objectives and qualities of accounting information. At the outset, it's important to recognize that accounting information is the source of information that investors and creditors and others use for making their resource allocation decisions. In other words, they decide where to invest or whom to lend to. Accounting information is the signal that provides the mechanism by which that capital is appropriately allocated. So there's a significant, important objective overall for accounting, that is to provide information useful for investment and credit decisions. Further, recognize that without that information flow, investors and creditors would likely make a number of errors in the allocation of capital, potentially resulting in the shortage of the production of necessary goods and services. Accounting information, its general purpose, it's designed to suit investors, creditors, analysts, governments, and other user groups. Accounting information is useful and helpful in assessing an entity's economic resources, in other words, primarily its assets, claims against those resources, in other words, the liabilities of the entity, and what causes changes in those assets and liabilities, or resources and obligations. That sounds very familiar to the balance sheet. The balance sheet provides information about assets, liabilities, and the residual amounts. The income statement, statement of stockholders' equity, those all signal what has caused changes in the available resources. Recognize that accrual accounting is designed to dovetail with providing the appropriate information. We've already talked in an earlier chapter about how cash flow information is important, and cash basis financial statements may provide important information, but ultimately the true inflows and outflows of an organization, the real drivers of economic activity, are fundamentally determined by accrual basis measurements. Hence, we tend to drive our accounting information set through an accrual basis model. Care must be taken to differentiate between additional equity that's brought about by investment versus by the earnings process. Obviously, over the long term, it's important that a business be able to sustain itself through earnings and profits and successful operations. In the short run, it may be possible to sustain operations by borrowing additional funds or attracting additional investors, but ultimately those investors and creditors will insist upon a return of their capital. So finally, ultimately, we need to be able to provide signals about what's causing changes in economic resources and claims against those resources. There are certain fundamental qualities that we look for in accounting information where that information is designed to meet the broad objectives of accounting. One of those clearly has to relate to relevancy. Relevancy means that information should be timely and bear on the decision-making process by possessing predictive or confirmatory, or in other words, feedback value. So relevancy is key. Ultimately, our objective of accounting, to provide useful information for investment and credit decisions, can only be met where information is deemed to be relevant in that process. And so when individual accountants prepare financial statements, or indeed when the Financial Accounting Standards Board undertakes to create standards, they think a lot about the information that they're providing, how it will be used, in other words, its relevancy to investors, creditors, and other users. But that is not the only quality. We also need to have faithful representation or truthfulness in what we're reporting. Information must be truthful, complete, neutral, or free from bias. It also needs to be free from error. So faithful representation is critical. Obviously, people want to rely on information that represents what it purports to represent. There are enhancing qualities to relevancy and faithful representation. Comparability is one of those. This simply means that even though different companies may use different accounting methods, one may use FIFO and one may use LIFO, nevertheless, there is still a sufficient basis for making comparisons between the companies and their respective success or failure in operating. Information or accounting disclosures should enable users to identify and understand the similarities and differences in the reports that they're looking at. Another enhancing quality is that of consistency. This has to do, rather than between firms, it has more to do with over time. Consistency means that if we see deviations in measured outcomes from period to period, those deviations should relate to differences in underlying performance, not differences in just accounting methods or some quirk of the accounting process. Certainly, consistency helps drive comparability. Another enhancing quality is that of verifiability. Obviously, a large part of the accounting profession concerns itself with audit or assurance services to look at reports and examine them and reach a conclusion and opinion about whether those financial statements faithfully represent. At the core of that is the ability to verify what's being observed. Different knowledgeable and independent observers of business activity should apply accounting methods to essentially produce the same financial reports. It's replicable. Timeliness is also important. Obviously, if we wait years and years and look back in the rearview mirror, we may be able to determine with certainty what actually occurred. The accrual measurements will have completed themselves and so forth, but that information would be so delayed as to become useless. So accountants have a fairly short horizon for reporting information to investors and creditors. It's critical that we have an accounting model that enables that timely reporting. That is, information is available in sufficient time to be capable of influencing the decision-making process. That necessarily brings into play the utilization of methods and estimations that are not absolutely correct, but fairly represent the business activities. Finally, another enhancing quality is understandability. Information should be clear and concise to those with reasonable business knowledge. You're in your first accounting class or perhaps your second accounting class. You've discovered there's a lot to know about accounting and a lot that you've yet to learn perhaps. Nevertheless, the skills you've already learned should impart enough knowledge to you to be able to use financial statements in a way that would enable you to make proper decisions about a business, even if you don't have full and deep, intimate knowledge of all the specific accounting principles that would be utilized. The accounting profession well understands that they are not preparing information for other accountants and accounting professionals. They're preparing information for broad user groups that just have a general business awareness. So it's very important that the reports that the accountants ultimately produce are understandable to those with reasonable business knowledge, but they don't need an advanced degree in accounting to be able to make good decisions based on the information, no matter the complexity of the intrinsic accounting models. Now, there is quite a lot of discussion about the vast number of accounting rules, the proliferation of standards. By some accounts, there's over 24,000 specific financial accounting rules. That calls into question whether we've gone too far in terms of a specific rules-based profession, that we've departed from some very fundamental principles. So you'll hear a lot said about principles-based accounting versus rules-based accounting. I don't believe the debate is as significant as it's perhaps made out to be, but there is some merit to the point. A principles-based approach argues that standards should articulate broad-based principles rather than specific and detailed rules, that general concepts should guide judgment in preparing financial reports, whereas a rules-based approach argues that standards should be very specific to provide adequate guidance and drive consistency in reporting. Without those specific rules, judgment could lead to wide disparities in what is measured and how it is reported. As I say, I think there's merit to both of these positions. Indeed, I believe the existing framework is principles-driven with specific defining rules that guide for the consistency we seek to achieve. But you will likely continue to hear for years and years to come arguments about whether we need a more principles-based or rules-based model. That's very simply what that debate is about, is trying to draw a divide between the ways in which accounting standard framework could be established.